Anil Sarin, CIO at Centrum PMS, is joining us right now on the show. Anil, thanks very much for taking out the time. Let's get in your assessment of what we're doing in terms of the market cycle right now and whether or not it's a good opportunity to make investments.
Sure. Happy to be here.
Right. Talk to us about your assessment of the current market mood and whether or not you recommend any fresh investments to be made at these levels.
So clearly, only a few days before the budget goes off, this is not the time to be very aggressive or to be very, very conservative. So at Centrum, we would like to be, adopting a wait and watch attitude at least till such time as the budget comes out. But on a longer term basis, I think, clearly the flows into the equity markets in India continue to remain strong. So, and there is a feeling that there is a bottoming that has happened as far as the economy is concerned. A lot of steps are being taken by the government across the board. So those are going to start reflecting themselves in an improvement in the economy. So as such, equity remains an attractive asset class, and we are medium-term positive on that.
Anil, good afternoon, Neeraj here. Just wondering, the portfolio management schemes in 2019 largely benefited by betting on the top tier names. Are you changing that strategy a bit, and are you looking at value, or are you still continuing to betting on growth?
So I would say 2019 was not even growth. It was more of quality which was driving, and it's so well known that just those 15, 20 top names were carrying all the burden of the market, and all the returns were coming over there. But as we look forward into the year 2020, we can't help but notice the extreme disparity in valuations. The Nifty 50 is trading 2 sigma above its mean for the last 16 years. It is trading 2 standard deviations above the mean. Against that, the Nifty Mid-Cap 100 is trading somewhere close to the average. So there is a disparity over there, which would suggest that some money has to move out from the A group and start moving into the B group. That is point number 1. Point number 2 is that in terms of trading turnover also, today what one is seeing is that the A group on average is accounting for 90% of the daily trading turnover, and the B group is barely around 7% of the daily trading turnover. This kind of polarization of trading volumes we last saw in early 2000, in the depth of a bear market where there was a lot of fear. So this kind of polarization we last saw around 20 years ago. So there is not much scope for trading turnover to further concentrate itself into the A group, and it would seem logical that a little bit of movement towards the B group would start happening. The last point, of course, is in terms of earnings. So if one takes on the aggregate, the Nifty earnings are flattish. For the last 2-3 quarters, there has not been much of growth as far as the EPS is concerned of the Nifty companies taken as a whole. On the other hand, if you take Nifty mid-cap companies, last 3 quarters they have shown very strong growth, albeit on a base which was weak. But on that weak base, YOY basis, year-over-year basis, for the last 3 quarters, the 3rd quarter ending in September, that is, there has been very strong movement as far as the EPS growth is concerned, and we will see how the December quarter results pan out. But so you have a situation where the valuations they have corrected quite a bit for the small caps, but they are quite strong for the A group large caps. And within the large caps also, there is a lot of narrowness in the leadership. The top 10 out of the top 50 Nifty stocks are accumulating most of the gains. So keeping all of these things in mind, 2020 we are cautiously optimistic about the B group, about mid caps and about small caps.
Anil, what would your assessment of the EPS growth be for 2020? And then if you have to put a target to the index, what would that be if you do put a target indeed?
So honestly, Devina, I don't have off the top of my head what numbers are, but broadly what is happening is most of the PSU banks are seeing a smart snapback because last year was a period, fiscal 19 was a period where a lot of bad loan accounting was being done, provisioning was being done, so the numbers were really bad. So on a YOY basis, PSU banks are showing very good EPS growth purely because of the fact that this year the provisioning is materially lower compared to the heavy amount of provisioning that was done during the previous year. So on a comparative basis, even though the top line may not be moving so much, even though the NIIs or the profits may not be moving so much, but post-provisioning profits are showing very strong growth. Now, most of the PSU banks are included in the mid-cap index, or none of them are large caps apart from SBI. So for that reason, and of course a few other reasons as well, but by and large I would say it is the PSU bank revival in the EPS thanks to much lower incremental provisioning, which is giving a boost to the EPS growth in the mid-cap domain. So that is causing some kind of a disparity, even though the economic gloom is there all around us. But on a declared profit basis, of course, the other benefit is of course coming from the reduction in the corporate tax rate. So put all of this together, you see this kind of a smart move as far as the mid-cap EPS is concerned, and relatively modest movement as far as the A group or the Nifty is concerned.
All right, while we await what the EPS growth will be, at least in the last 3 to 4 years, we've not been able to get that high double-digit growth coming in for Nifty at least. But talking about earnings, you've got the numbers of PVR flashing there on your screen. Top line, it's a downtake. Net profits are down, by the way, 34%. It's coming at 36. It's way below what the Bloomberg estimate was throwing about. Revenues are down about 915 is the revenue number, what I can see. It's the consolidated number, what I'm reading from the release they've given it. I think the finance cost has gone up significantly higher for the quarter, 122 crore versus 37 crore, which was there in the corresponding quarter. Even if you look at the September quarter, finance cost was 111. So I think that may have impacted the bottom line growth this time around. But in terms of operating performance, EBITDA is showing an uptick of about 87%. And PVR stock futures were quite active, I guess, right from the word go in the morning. There was a lot of build up, but the stock's not reacting too much. It did initially react post the numbers. Right now, it's just about trading flat. We'll get you more finding. Anything else, Neeraj, you're saying?
No, just the depreciation and amortization as well, compared to the kind of uptick that they've seen in revenues on a YOY basis. Depreciation numbers of 51 crores for the quarter gone, like a comparable quarter. It's at 134 crores. So that's one more aspect that might have impacted, even though the other expenses have come off quite rapidly. Yep. I think depreciation too has inched up quite dramatically.
Yep, that's PVR for you. And remember, so far for the quarter, most of the brokerages were highlighting due to lower ad revenue growth, which we've seen in the case of Z. Exhibitors like PVR and Inox were supposed to put up a good show, but PVR for the time being is just about trading flat. Anil, any thoughts on the media space? We've got Z earnings coming, we've got PVR today, and there's been disappointment, I guess, so far.
So obviously the first thing that brand managers cut when faced with a demand slowdown is the discretionary spending, which is the advertising. So it is to be expected. I mean, if there is a retrenchment by the consumers, there is going to be cost-cutting pressure on the brand managers, and the easiest place to go and cut is in the advertising and brand promotion, which is what you are seeing. But with regard to PVR, I think you should be aware of this, that there is this accounting standard 116, which has come into force from this fiscal year onwards. So you will see again and again, it has the effect, especially in those companies which have a high amount of leasing, which is true in the case of PVR. They don't own the cinema hall property, they lease the cinema hall property. So what this accounting standard 116 has done is, it has artificially enhanced the EBITDA, and that rent expense is now actually taken somewhere at the interest level, at the depreciation level. So you will find an unnatural increase in the EBITDA and an equally or sometimes more than equally unnatural increase in depreciation and interest. So this is due to the recent changes in the accounting norms. So one will have to look through all of this and then focus on the top line and the core profitability, adjust for the rent, and thereby come to a better understanding of what has happened at PVR.
Okay. Anil, do you have a take on real estate now ahead of budget that also gets more prominence, a lot more active? We've seen a lot of these stocks getting extreme amount of interest. I'm just throwing names right now because these are the stocks that have been active. So likes of prestigious states, you necessarily don't have to talk individually about stocks, but just the sector as a whole and what the government has done so far in order to make sure that the supply stream remains constant, but whether or not that's enough to spur demand is a question.
Yeah, so you know, what is happening in real estate is something very interesting. It's not that the overall demand is going up, far from it. In fact, some respected analysts in the space say that 8 out of 10 developers which are there today will not exist in the next couple of years. So there is a lot of pain in the system. Despite that, the listed players are seeing you know, a great run. In fact, over the last year, if you see, if there is one sector which has rewarded shareholders, it is the real estate sector. So what is the reason behind this apparent schizophrenic behavior where the sector is doing badly but the listed stocks are doing very well? I think the reason comes down to this extreme change in the market share. What is happening is that thanks to two regulations, GST as well as RERA, the advantage has shifted from the unorganized players towards the organized players. So what one is seeing is on an incremental, on a going forward basis, while the earlier market share of all the listed players put together in terms of volume in the residential segment of real estate, it would have been less than 10%. That is the historical number. But if you look at the future in terms of incremental market share, it is well above 60% because the advantage has shifted so dramatically in favor of the large players who have access to capital, who have access to private equity, who have access to, thanks to their brand, they can access you know, the booking amount from the homeowners who want that residential apartment to come. So they have the sales and support and the marketing infrastructure. So the shareholders, so the market has noticed this, and as such, the prices, the valuations of listed players are going up dramatically, even in the face of so much turmoil, so much pain in the sector as a whole. So market is looking ahead and saying that on a going forward basis, you know, the listed real estate players are going to do well because these urbanization and nuclearization of families, where larger families splinter into smaller homes as the family gets bigger and bigger, these two trends are secular multi-decade trends. So people are not going to stop buying houses anytime soon. People are going to move from villages to the towns on a continuing basis over the multiple decades. But who is going to benefit? It is the larger, well-organized people with brands, with access to capital, with execution capacity. So that, I think, is the underlying reason for the performance of real estate companies. You can pick any one of them. And allied to that is the expectation within the budget that there is going to be some support, something to help the sector get out of its doldrums that it finds itself in. So those are the two reasons which are underlying the continuing outperformance of most of the real estate stocks.
Okay, Anil, we'll leave it at that. Thanks much for taking the time out and speaking to us. Appreciate your time today.